What if this year could be your most profitable yet? Imagine turning today's biggest financial opportunities into long-term wealth. But where exactly should you put your money? In this video, we'll uncover the key investment trends shaping 2025 and help you make smarter financial decisions. Welcome to the channel, where we dive deep into finances, investments, and the mindset behind building wealth. Whether you're just starting out or looking to optimize your portfolio, this video is packed with insights to help you grow and protect your hard-earned money. This year brings a unique mix of challenges and opportunities, from breakthroughs in technology to shifts in global markets. We'll explore the top growth sectors, proven strategies to balance risk, and even some overlooked investment gems you might not have considered. But before we dive in, here's why this is important. Staying ahead of trends isn't just about making money, it's about creating a financial safety net for your future. So let's get started with the first trend, where we'll highlight 3 industries projected to thrive this year. So, where are the smartest investors putting their money this year? To answer that, let's look at the top 3 sectors that are set to thrive. These industries aren't just surviving economic shifts, they're leading the charge and shaping the future. First on the list is green energy. With governments and corporations around the globe doubling down on sustainability initiatives, this sector is experiencing massive growth. Clean energy solutions, like solar, wind, and energy storage, are not only better for the planet, but also lucrative for investors. For example, the demand for solar panels and battery technology is skyrocketing, and companies leading these innovations are seeing impressive returns. Investing in ETFs like the iShares Global Clean Energy ETF can provide broad exposure to this booming industry. Next, let's talk about AI and technology, a trend that's impossible to ignore. AI is no longer just a buzzword, it's revolutionizing industries from healthcare to finance. Think about autonomous vehicles, predictive analytics, or even the algorithms that run your favorite apps. The tech giants and startups driving these advancements are attracting massive investor interest. Look for opportunities in ETFs focused on AI, or consider individual stocks like those in cloud computing and software development. Finally, healthcare innovations are set to dominate. From breakthroughs in biomedicine to advancements in telehealth, this sector continues to grow, even during economic uncertainty. Aging populations and increased healthcare spending worldwide make this a long-term investment opportunity. Companies working on cutting-edge treatments or specializing in medical devices are particularly worth watching. These 3 sectors, green energy, AI, and healthcare, offer exciting opportunities for growth. But as with any investment, diversification is key. Up next, we'll discuss how to balance risk and reward in your portfolio to maximize gains while protecting your wealth. Now that we've highlighted the top growth sectors, you might be wondering, how do I capitalize on these opportunities without exposing myself to unnecessary risk? The answer lies in balancing your portfolio to ensure it thrives in both good times and bad. Let's dive into how you can achieve that balance. Every investment comes with some level of risk, but the key to long-term success is managing that risk effectively. Think of your portfolio like a ship. It needs a solid foundation to weather the storms while still being nimble enough to catch the winds of opportunity. The first rule of balancing risk is diversification. This means spreading your investments across different asset classes, such as stocks, bonds, and real estate. By doing this, you reduce the impact of any one sector or investment underperforming. For example, if tech stocks experience a downturn, having bonds or dividend-paying stocks in your portfolio can help offset those losses. Traditionally, the 60-40 portfolio is a mix of 60% stocks and 40% bonds. It has been a go-to strategy. While it's a solid starting point, many investors are now exploring more dynamic allocations, such as incorporating alternative assets like real estate investment trusts, REITs, or commodities like gold, which can provide a hedge during market volatility. Understanding your risk tolerance is another critical step. Are you someone who can handle the ups and downs of high-growth sectors, or do you prefer steady, predictable returns? Knowing this will help you decide how much of your portfolio to allocate to higher-risk investments like tech or lower-risk options like treasury bonds. Balancing risk and reward isn't about avoiding risk entirely. It's about making calculated decisions to maximize your returns while protecting your downside. And one of the most exciting opportunities this year lies in the rapid growth of artificial intelligence. Coming up, we'll explore how AI is transforming industries and why it's one of the hottest investment trends to watch. Now that you understand how to balance your portfolio, let's dive into one of the most exciting and transformative trends of this year: artificial intelligence (AI). This isn't just another tech trend. AI is reshaping entire industries and presenting a wealth of investment opportunities. Artificial intelligence is no longer a far-off concept. It's embedded in everything from the apps on your phone to how businesses analyze big data. AI is a game changer in sectors like healthcare, automotive, finance, and even entertainment. For example, AI's role in predicting health outcomes or improving diagnostic tools is revolutionizing the healthcare industry, offering significant long-term growth potential. Investing in AI can be done in several ways, from individual stocks to ETFs. One popular option is to look at companies directly involved in AI development, such as major players like NVIDIA, whose chips power AI-driven systems, or Alphabet Google, which is investing heavily in AI research and applications. Another way to get exposure is through ETFs like the Global X Artificial Intelligence Technology ETF AIQ, which offers diversified exposure to the AI sector. However, like all high-growth sectors, AI does come with risks. The technology is evolving rapidly, and regulatory challenges could impact companies involved in AI development. As with any emerging market, it's essential to stay informed and adjust your portfolio as the landscape changes. Artificial intelligence is transforming the future of technology and business, making it a sector well worth considering for your investments. Up next, we're going to look at another way to secure passive income through real estate investments. Let's explore how real estate can add stability and growth to your portfolio. While AI offers tremendous potential for growth, another area that remains a cornerstone of stable, long-term investment is real estate. Whether you're a first-time investor or a seasoned pro, real estate offers opportunities for consistent passive income and wealth building. Let's take a closer look at how you can leverage this sector in today's market. Real estate has always been a powerful wealth-building tool, and in uncertain times, it offers stability and potential for appreciation. Unlike stocks, which can be volatile, real estate tends to increase in value over time, especially in high-demand areas. Furthermore, properties can generate passive income through rental yields, making them ideal for long-term investors looking to earn without constant oversight. For those who don't want the hassle of property management, real estate investment trusts (REITs) are an excellent alternative. REITs allow you to invest in real estate portfolios without having to directly buy or manage physical properties. Many REITs focus on commercial, residential, or industrial properties and offer solid returns through dividends. For example, investing in a broad-based REIT like the Vanguard Real Estate ETF gives you exposure to a wide array of properties without requiring the capital or responsibility of owning physical assets yourself. Another option is real estate crowdfunding platforms, which let you pool your money with other investors to fund projects such as apartment buildings, commercial real estate developments, and more. These platforms offer opportunities for both accredited and non-accredited investors and can provide high returns, though they tend to carry more risk. Platforms like Fundrise and Realty Mogul allow you to diversify your investments into various real estate sectors. Real estate can be an excellent source of passive income and stability, providing you with opportunities for both long-term growth and consistent returns. But, as we'll see in the next chapter, another way to ensure steady wealth building is by investing in dividend-paying stocks, a strategy that many successful investors rely on. Let's dive into why dividend stocks should be a staple in your portfolio. Now that we've explored real estate, let's talk about dividend-paying stocks, a powerful way to generate consistent income and build wealth over time. While real estate provides stability, dividend stocks offer the unique advantage of cash flow and compounding growth, making them a must-have for many investors. Dividend stocks are shares in companies that pay out a portion of their earnings to shareholders in the form of dividends. This creates a reliable source of income, often quarterly or annually, which can either be spent or reinvested to accelerate your wealth building. The key benefit is predictability. Dividend payments are usually regular and can provide a buffer during market downturns. Companies that pay dividends are often well-established, stable businesses with a history of strong financial performance. These businesses prioritize rewarding their shareholders and typically have lower volatility compared to growth stocks. For example, some of the most well-known dividend-paying stocks come from sectors like utilities, consumer goods, and healthcare. Think companies like Johnson & Johnson, Coca-Cola, or Procter & Gamble. Reinvesting dividends is one of the most powerful wealth-building strategies. By automatically reinvesting the dividends you receive, you purchase more shares, allowing your investment to compound. Over time, this strategy can significantly amplify your returns. In fact, reinvested dividends have been responsible for a large portion of long-term stock market gains. To build a strong dividend portfolio, focus on companies with a consistent dividend history and a track record of increasing dividend payouts. Additionally, look for companies with strong fundamentals, healthy cash flow, low debt, and a sustainable dividend payout ratio. ETFs, such as the Vanguard Dividend Appreciation ETF VIG, can help you achieve this by offering diversified exposure to high-quality dividend-paying companies. Dividend stocks are a powerful way to secure passive income while growing your wealth steadily. As we move forward, there's one more investment trend that is gaining traction this year: sustainable investing. Let's dive into how you can invest in a way that aligns both with your financial goals and your ethical values. As we've discussed, dividend stocks and real estate provide solid, predictable returns. But what if you could align your investments with your personal values while still generating strong returns? That's where sustainable investing comes in. This approach allows you to invest in companies that prioritize environmental, social, and governance (ESG) factors, making a positive impact while building wealth. Sustainable investing refers to the practice of choosing investments based not only on financial performance but also on their social responsibility and environmental impact. Investors are increasingly seeking out companies that are working to reduce their carbon footprint, promote equality, and maintain strong ethical standards. This trend is growing because people want their investments to reflect their values without sacrificing profitability. Contrary to what some may think, sustainable investments can be just as lucrative, if not more so, than traditional investments. Companies that focus on sustainability often have lower long-term risk and higher growth potential. This is because they're more adaptable to changes in regulation, consumer preferences, and global challenges. One way to gain exposure to sustainable investments is through ESG-focused ETFs and mutual funds. Funds like the iShares MSCI KLD 400 Social ETF or the Vanguard ESG US Stock ETF allow you to invest in companies that meet specific social and environmental criteria. Many of these companies are not only leading in sustainability, but are also positioned for future growth, which can result in strong financial returns over time. Sustainable investing offers the best of both worlds, doing well financially while making a positive difference. But to maximize your potential in any investment strategy, staying informed and adjusting your portfolio as the market evolves is key. In our next chapter, we'll wrap up with some final thoughts on making smart investment decisions this year. We've covered a lot of ground today, from the hottest investment trends to strategies for balancing risk and reward. Let's wrap up with some key takeaways to ensure you're ready to make the most of your investments this year. One of the most important lessons we've learned is the value of diversification. Spreading your investments across various sectors like green energy, AI, and real estate not only positions you for long-term growth, but also helps reduce risk. Always remember to stay informed, as market conditions can change quickly. Dividend stocks and real estate offer passive income opportunities that can provide a steady stream of cash flow while helping you build wealth over time. Reinvesting dividends or exploring REITs for real estate exposure can boost your returns without the need for active management. Sustainable investing is another powerful strategy to consider. It allows you to generate profits while supporting companies that are making a positive environmental and social impact. ESG investing isn't just good for the planet, it can also lead to strong financial returns, as companies with sustainable practices are often more resilient in the long run. The key to successful investing this year is staying flexible, adaptable, and proactive. Always keep an eye on emerging trends, make well-researched decisions, and adjust your portfolio as needed. If you found this video helpful, don't forget to like, subscribe, and share with anyone who could benefit from this information. Thanks for watching, and here's to making smart investments this year.